Hello and welcome back to our channel Polo Vega. Ladies and gents, we talked about derivatives in our last video. Taking a step further, we shall talk about forwards and futures, which are two similar types of derivatives that people use over a range of underlying assets such as forex, commodities, equities, indexes, energies, metals, and many more. But before we go on to our video, let's look at the disclaimer/disclosure clause. Disclaimer/disclosure. The contents of this presentation are for information purposes only. The material has been obtained or derived from sources believed to be accurate, but we do not guarantee its accuracy. The presentation is the 10th of a series of interactive videos aimed at educating our viewers about forwards and futures as financial securities based on various underlying assets that one can trade on various exchanges or over the counter. Futures and forwards. Futures and forwards are contracts that are used by businesses and investors to hedge against risks or speculate. They derive their value from underlying assets and rely on locking in a specific price for a certain asset. The underlying assets fall under three categories. Financial assets include stocks, bonds, market indexes, interest rates, and currencies. They are considered as homogeneous securities that are traded in well-organized, centralized markets. Commodities such as grains, metals, energies, which are considered as less homogeneous than financial assets and are traded in less centralized markets around the world. We then have the other derivatives which exist only as hedges against events such as natural catastrophes, rainfall, temperature, snow, etc. These are not traded on exchanges but as contracts between private parties. Forward contracts versus futures contracts. A forward contract is an obligation to buy or sell an asset at a specified price, which is a forward price, at a specified date, which is a contract maturity or expiration date, and typically they're not traded on exchanges. Futures contracts, however, are the same as forwards except for two main differences. Futures are settled daily, not just a maturity, meaning the futures can be bought or sold at any time during the life of the contract. Futures are typically traded on standardized exchanges. Building up on our discussion from the previous slide, we can see that there's no theoretical difference between forwards and futures, as both of them are contracts that fix the future value of the underlying asset at a particular value at a particular date. On the date of expiry, the future value converges with the spot value of the underlying asset. There are a few differences between the two in accordance with the way the contracts are executed and the way the two derivatives are traded. What we can see is that the futures are settled daily, while forwards are settled at maturity. Futures are standardized products, whereas forwards are non-standardized. There is a low risk of not fulfilling obligations in case of futures due to regulation and oversight, whereas in case of forwards, there's low level of regulation and oversight on settlement. Finally, we can see that futures are traded on public exchanges, while forwards are private contracts between two parties. Lifespan of futures contracts. Futures contracts have a limited lifespan, as these contracts have an expiry date, as opposed to stocks that trade in perpetuity. Three important terms related to the lifespan of futures are as follows. Contract expiration options. A contract's expiration day is the last day that you can trade the contract. This typically occurs on the third Friday of the expiration month, but varies with contract. Prior to expiration, a futures trader has three options. The first of them is offsetting a position. This is the simplest and most common method of exiting a trade. A trader is able to realize all his profits/losses associated with that position without taking physical or cash delivery of the asset. The second one is rollover, which is when a trader moves his position from the front month contract to another contract further in the future. A trader intending to roll over his position will switch his position when the volume in the front month contract has reached a certain level. He will offset his current position in the front month and simultaneously establish a new position in the next month's contract. And finally, settlement. If a trader has not offset his position prior to contract expiration, then the contract will expire and the trader will go to settlement. At this point, a trader with a short position will be obligated to deliver the underlying asset under the terms of the original contract. This can be physical delivery or cash settlement depending on the market. Settlement of futures contracts. A futures position must be closed out either before the first notice day in the case of physically delivered contracts or before the last trading day in the case of cash settled contracts. Physical settlement. Non-financial commodities such as grains, livestock and precious metals most often use physical settlement. Upon expiration of the futures contract, the clearinghouse matches the holder of a long contract against the holder of a short contract. The short position delivers the underlying asset to the long position. The holder of the long position must place the entire value of the entire contract with the clearinghouse to take delivery of the asset. Many financial futures contracts such as the E-mini futures are cash settled upon expiration. This means on the last day of trading, the value of the contract is marked to market and the trader's account is debited or credited depending on whether there is profit or loss. Special considerations. Futures contracts have different expiration months throughout the year and many extend into the next year. Each futures market has its own specific expiration sequence and examples as follows. Financial instruments such as S&P 500 E-mini futures or US Treasury bond futures use quarterly expiration months of March, June, September, and December. Contract month code H, M, U, and Z. Commodities markets are loosely tied to the mining, harvest, or planting cycles, and many have 5 or more delivery months in 1 year. Energy futures such as crude oil have monthly expiration dates as far into the future as 9 years. It's important to know that the expiration dates and the last day of trading dates are not the same. For energy especially, contracts stop trading in the month prior to the expiration month. Therefore, selecting the proper expiration month for a trading strategy is quite important. Backwardation and contango. Backwardation and contango are terms that describe the shape of a commodity futures curve. Backwardation occurs when a commodity futures price is lower for each successive month along the curve, resulting in an inverted futures curve. The futures spot price, which is the front month price, is higher than the next month's price, and so on. Backwardation occurs when a commodity's current price is higher than its expected future price. Contango refers to a normal futures curve for a commodity where its futures price is higher for each successive month along the curve. The spot price is lower than the next month's price, and so on. This makes sense intuitively as physical commodities will incur costs such as storage, insurance, financing, etc. Therefore, the spot rate of the commodity is lower than the commodity's future price. We hope you enjoyed our short video presentation on futures, their lifespan, trading strategies based on their life and settlement on the expiration. In our next video, we shall talk about options as an exotic asset class that give a range of choices to every trader and investor and form a must-have tool for hedging positions in volatile markets or speculative tool during calm conditions. If you liked our video, please press the like button underneath, and to watch more, please subscribe to our channel Polo Vega. Until then, please keep saving, keep investing, and keep getting wealthier. You may also visit us at our website www.polovega.com or contact us at our Twitter handle @PoloVega. We thank you once again for watching our video and look forward to seeing you next time.